Morning, everybody. My name is Michael Valtos, and today I'm going to be talking about order flow. That was just a great presentation by Silas earlier, and it's just fascinating. There's so many different ways to approach the market, and what I'll be talking about is the way I approach the market. People trade very short term, medium term, long term. Order flow is on the very short term spectrum of trading. So in this training, I'm going to show you how to identify aggressive traders, trade in sync with the market, and I'll talk about a low risk order flow trade setup, right? We all like to have trades, but we also want to have low risk trade setups. And I'm going to be talking about that a little bit later. Now, if you stay till the end, I'm going to show you how to get a copy of the book that I wrote on order flow. It's called Trading Order Flow, and it's going to teach you how to determine what the institutions are doing. It's going to talk about how not all prices are the same, how to limit your risk on a trade, how to determine price rejection, how to understand value in the market, and much more. So if you stick around till the end, you can be able to get a free copy of this. It'll be a digital download. It's not going to be the actual hard copy. Now, why order flow? Well, to me, order flow is the market, right? It's not some indicator or Fibonacci or pivot points, right? Order flow is the trading that's occurring in the market as as people are buying and selling in the two-way auction, and only order flow gets you as close to the market as possible. Now, people are going to say, what does that mean? Get me as close to the market as possible? Well, now everything is screen traded, okay? And in the old days, there used to be the trading floor where people would pay a lot of money to be members on the trading floor to see who's buying and who's selling. If there's a lot of volume coming into the market or not, as opposed to just looking at ticks on the screen. Now, what order flow does is it allows you to see that volume in the market. And once you understand order flow, you're going to understand the market, right? This is all the charts I'm showing you is from yesterday, right? The December 16th. I like to keep it current, to show you that what I talk about happens every day in the market. So this was the E-minis. I'm going to show you how to see what other traders don't see, which lead to the big moves in the market. S&Ps, all these markets nowadays, a lot of volatility. You get big moves intraday, which is great. This is Japanese yen, right? By using the order flow, you're going to see and understand what's happening in the market more clearly. This is wheat, right? A nice move from the low of the day straight up. And I'm going to show you how to easily read an order flow footprint chart. This is an order flow footprint chart as opposed to a normal bar chart. And you're going to see there's a lot of information if you know what to look for. I'm not saying you have to analyze every tick. That's what some people will have you believe that order flow is about analyzing every single tick that goes through and trying to, sort of put it in pieces of the overall trading puzzle. So before I get started, I want to talk about who I am and why you should listen to me about order flow. So this is the first time you're at one of my presentations. My name is Michael Valtos. I've got over 25 years of professional trading experience. I started on the CME floor in the early 90s with Dean Witter Reynolds. I literally started at the bottom. I said, I want to be in the finance industry. I started as a runner on the CME floor. That's the lowest you can start. Okay. And eventually, I worked my way up from there. After I left the CME trading floor with Dean Witter, I went to the electronic trading desk, which is when the electronic market started becoming popular back in the early 90s. And I spent a few years there. Then I left Dean Witter. I joined the global macro trading desk at EDF Man. It's a big English trading company. I spent a couple of years there. Then I joined Commerzbank. I became the licensed Eurex trader in Chicago. The only one in Commerzbank in Chicago that was able to trade Bunds, Bobbles, Schatz, DAX, all the German products against the U.S. products. After that, I joined Cargill, the big American commodity trading firm. I think now it's the second largest private firm in America. Koch Industries, I think, just became first. But, it accounts for about 30% of grain exports and about 25% of meat exports. But they trade everything. Anything around the world that's tradable, Cargill's got their fingers in it. After Cargill sent me out to Singapore, actually, to set up a trading desk for them in Singapore when the trading floor on Cymex closed down. And so after A few years at Cargill, I left and I joined JP Morgan, vice president of futures trading. Sat on the trading desk. I wasn't sitting in a corner office looking at charts. No, I was on the trading desk banging out trades all day long from 6 in the morning when Globex reopened in the U.S. until about 5 o'clock in the evening Singapore time. And in 2013, I left JP Morgan after my daughter was born to spend more time with my family. I just needed to get away from the corporate rat race and trade for myself. I started writing my book, and in 2015, I started Orderflows. Okay, but this presentation is not about me, right? It's about showing you how you can improve your trading by understanding what's happening in the market. Use order flows. This is one of my users, who writes to me. I can clearly see now what's happening in the market. For example, who's in control of the market on a very specific time and who's getting weaker as well, right? I want you to understand what's happening in the market. Now, disclaimer, the charts and tools that I use in this training are generated from my order flow software, right? I said in 2015, I started a software company called Orderflows. And what I'm going to be talking about today can easily be applied with other order flow footprint software if you know what to look for. I find mine, I created my software to help my own trading. That's how order flows started, right? I was using another company's order flow tool, but it wasn't good enough. It was just a very basic thing. And I said, you know what? Computers should be able to do a lot more than just plot data on there. I wanted it to help me do the analysis so I could look at more markets and sort of, cover more things. So I'm going to show you how to easily and quickly apply order flow analysis to your trading so you make better trades, right? Low risk trades. Now, before I begin, I just want you to understand, trading is risky, right? You should only trade with capital you can afford to lose, and make sure you got sufficient capital that's separate from your living expenses. So what I want to talk about today is, aggressive traders, right? People say, what's aggressive traders? Well, being able to identify aggressive traders is the easiest way to make sense of the order flow, right? Order flow is about identifying the immediate trends of prices, right? Where the next 4 or 5 ticks are going to be, and if this move is going to continue, right? An order flow trader makes decisions from each succeeding trade in the market. Think of the market as a kaleidoscope, those things you look into and you twist it. Order flow traders are always gauging the supply and demand and the forces behind it. But what really causes a market to move? It's the aggressive traders. But what exactly is an aggressive trader, right? This is a picture of Trading Dome, okay? And you see there's bids and there's offers, right? There's the best bid, the best offer, right? Markets trade in a two-way auction. A lot of traders don't even think in terms of the two-way auctions. You just think of, well, the price, the market traded 36.91. But you can see here, right? It's 91 bid at 89 3/4. Okay, so it's kind of a wide bid offer, but because I left out 36.90. But you can see people that are working on the bid and below are what's considered passive buyers, right? You can see the 101, the 164, the 296, the 264, the 289. All these people are what's considered a passive buyer. They're waiting for the market to trade down before they buy. Whereas passive sellers are those on the offer and above. They're happy to sell at 36.91 if the market comes to them. They're happy to sell at 91 1/4 if the market comes to them. There's no rush to trade, right? They're considered passive sellers. So you have an order book, right? The order book is full of passive buyers and passive sellers. But the aggressive traders are the ones who cause the market to move. There's a saying, in the old days, you used to have to call your broker, why did the market go up? And you say, well, there was more buyers than sellers. Okay. Well, that's really misinformation, disingenuous information, because what's actually happening on a move up is there are more aggressive buyers than aggressive sellers, right? You have passive buyers here, but there's more people buying the offer, buying everything out at this level, 36.91, clear it out. They buy everything at 36.91 1/4, right? So there's not more buyers than sellers. What you have is more aggressive buyers than passive sellers going on. That's what's causing the market to move up, because they're clearing out all the offers in the market on the way up. Just as on a move down, there's more aggressive selling than buyers. So markets don't move because a trader's working bids and offer. Okay, and a lot of people that trade on a dome, they actually, they sit there, they like to look at a dome, just like this, right? Stare at your screen and see it flashing back and forth, big numbers coming in, and they may see a big offer or a big bid come in, and they try to jump in front of it. That's one of the deadliest things to do, actually, is sometimes jump in front of a big order, in the sense that it's just sitting in the book. Okay, because people, even though there's laws against spoofing, it sort of does still happen in a way. People think that, oh my gosh, there's a big bid at 36.89. I'm going to buy, the 89 and a quarters. I'm going to just jump in front because there's a big buyer. They must want to get it. But speaking as an institutional trader, right? I did that for, over 20 years. Is as a big trader, when you see big size in the market, that's your opportunity. If you know if we wanted to sell, and someone shows 36.89 bid for 800, and I got 1,000 to sell, even though the market is trading 89 and three quarters bid, I just hit it all down to 89 because I know that I'm such a big trader. I've got a lot of supply to sell. If I see a big bid there, I'm just going to hit it because I have so much to sell that eventually my selling is going to move the market down. So if somebody puts a big bid in there, I'm just going to whack it. Okay, so that's not what a lot of retail traders think. They actually think the opposite. They think, well, there's a big buyer, a couple ticks below the market must be going up. That's not what moves the markets, right? It's the actual trades that move the markets. So for a trade to happen, the aggressive buyer has to cross the bid offer and lift the offer, right? Aggressive buyers buy from the passive sellers. Aggressive sellers, on the other hand, they cross the bid offer and sell into the bid. They sell to the passive buyers. All right. So, again, think of the two-way auction. There's a bid and there's an offer in the market. So trying to watch order flow on a dome is hard. It really moves so fast. And if you look away to sip of water or pick up your phone or something, you could miss something important in the market. But an order flow chart, right, a footprint chart, is really, what I consider the only chart you need to look at, because it has a lot of the information. And what's beautiful about an order flow chart, a footprint chart, is, like the previous speaker, Silas, right? You can actually put those tools on a footprint chart, and you can find better trading opportunities because you're going to see what's happening in the market, right, with the aggressive traders. Okay, so you can see, there's a lot of numbers here. People get scared. They look at a footprint chart and think, oh my gosh, so much numbers. I don't know what to make of this. But when I first walked on the trading floor at the CME, I thought it was complete chaos. But after, a day or two, after it was explained to me what to look for, what I was looking at, I understood it, right? And a footprint chart is the same way, right? You'll see the volume traded on the bid, the volume traded on the offer at a price, at a two-way auction. You can see where markets are strong, markets are weaker. There's just so much information on there. You can see where the aggressive buyers are present. You can see where aggressive sellers are present. So aggressive traders, how by now, hopefully you can understand what an aggressive trader is, right? It's someone that wants to get filled, basically, right? The passive buyer or passive seller is just someone happy to sit on the bid or the offer and wait for the market to come to them. But an aggressive trader says, you know what, I want to get filled. I need to get out of this position. Just sell it at the market. That's an aggressive trader. Okay, and aggressive traders cause imbalances in the market and can be seen in the order flow footprint chart. Now, aggressive trading can also be seen in the order flow delta number. So delta and imbalances are two of the most important pieces of market generated information from the order flow. Now, just really quick, delta, order flow delta, don't be confusing it with options delta, which is something completely different. In order flow, delta is the net difference between aggressive buyers in a bar and aggressive sellers in a bar. So generally, if a bar has negative delta, it's telling you aggressive sellers were in control of a bar. And conversely, if a generally if a bar has positive delta, aggressive buyers were in control of the bar. Now, sometimes it may deviate a little bit, but that's a whole nother presentation for another time. Now, imbalances, order flow imbalances are the result of aggressive trading in the two-way auction. Now, you can determine what you consider an imbalance, okay? I mean, the industry standard is 4-to-1. Some people use 3-to-1, some people use 5-to-1, some people use 10-to-1. 9.87-to-1. It's up to you. They said the industry standard is 4-to-1. 3-to-1 is also very nice. So when aggressive buyers outnumber aggressive sellers by a certain percentage, it's considered a buying imbalance, and it's going to be a blue number in the footprint. It's going to appear there. The volume will appear blue, as you can see. In this on these green bars here, you have buying imbalances. When aggressive sellers outnumber aggressive buyers by a certain percentage, it's considered a selling imbalance, right? It's in the two-way auction, right? So you could see 123 traded on the bid versus 6 on the offer. That's more than 4-to-1. That's considered an imbalance. I have this chart set to 3-to-1. 273 against 70 is more than 3-to-1. 258 against 34 is also an imbalance, right? So you can see the red numbers generally are going to appear on down red candles, and generally buying imbalances are going to appear on green candles. And people say, well, if you got buying imbalances in green bars and selling imbalances in red bars, I don't need order flow. Well, when you get to lows of the day, right, you're always going to want to be looking for signs in the market that the move down is over, right? I'm not trying to pick a low. I'm letting the market tell me the low has been made or the high has been made. I'm going to be looking for aggressive selling coming into the market. Okay. Now, when aggressive traders cause market imbalances, and there are multiple imbalances in bar, that tells you a market is out of balance. So, like I said, often bars have buying and selling imbalances, but when you see bars that have 1, 2, 3, 4 imbalances, 1, 2, 3 imbalances, especially when a bar has only 1, 2, 3, 4, 5, 6, 7 price levels, but literally half the bar is buying imbalances, what do you think that means, right? It means that aggressive sellers have finally stepped into the market, and you would expect the market to rally. Just as if you had a red bar, a down candle, with a lot of selling imbalances, it's telling you the aggressive selling is really strong and the market probably has more capacity to move down, right? And when a market is out of balance, that's often when vertical moves start because one side is in control of the market. But what I'm going to be focusing on today is imbalances. I'm not going to talk about delta today. I'm going to be talking about imbalances. So what do you see in these bars here? You have 3 green bars off this low here, off the swing low. You got a bar with 2 imbalances, 2 buying imbalances, a bar with 1, 2, 3, 4 buying imbalances, another bar with 1, 2, 3 buying imbalances. So the market has been selling off. It goes sideways. At this point, you should be asking, is there more potential for this market to go lower? Or is buying finally come in, and it looks like we're going to start a trend up, right? A reversal from this move down. That's where the order flow is going to help you. On a candlestick chart, this is the same chart right here. What you're seeing on this order flow chart is this chart, right? This normal candlestick chart. You just see the open, high, low, close, right? And people will say, well, yeah, we close lower than where we open. Obviously, sellers are in control. Okay, and they'll say, well, down here you got these pin bars. Well, here you had a pin bar, right? You had the same type of bar, right? The hammer formation, right? Market traded down and then buying came in, moved it back up, but then you just traded lower. Okay, maybe you took this trade, you got stopped out. But why should you take this trade if there's nothing in the order flow to tell you to be getting long? Just as here, if you're buying the next bar, your stop is right below the low, you just got ticked out, right? So you had 2 losing trades. But if you just wait for the order flow to tell you, aggressive buying is coming in, it came in on these 3 green bars, that was your sign. People say, well, you had a lot of red bars down and you got some green, you just buy it. Well, you had green bars earlier and you still went down. So, it's, trading is not complicated once you understand who's in control, if there's anybody in control. Sometimes, the market, there's no one side in control of the market. It's just doing what it's supposed to do. It's facilitating trade. People are trading. But with order flow, you can see without a doubt, right, when the market is exhibiting imbalances, right? Because you're analyzing what is being traded in the market, right? You can see, markets come down. You got the last couple selling imbalances right here. Then it's all buying imbalances. 2, 4, another 3. So you got 10 buying imbalances almost literally at every price level on the way back up, right? So at this point, you should, when we hit this 36.82 yesterday, that attracted buyers. People thought the market was cheap and came in with a vengeance and said, hey, you know what? This is a very good buying opportunity. And they came in and started buying, right? But that's E-minis. What about other markets? Here's crude oil yesterday, right? Knowing areas of imbalance is going to help you. Again, you had this nice sell-off down to 47.25. It just sort of goes sideways in here. Market went up and it pulled back literally right to this level. Why? Because in here, where this arrow is pointing, there's buying imbalances. You can't see it on a normal candlestick chart. The information is just not available to you. So this is that area in that box right here, right? The bar, we got 4 buying imbalances. Okay. And even in some of these other bars preceding it, you've got a couple green candles with 2 buying imbalances, another 2 buying imbalances. So, buyers are being attracted, right? We just had a sell off from 47.70 down to 47.30, a nice 40-cent move. Okay. And then the market's sort of going sideways. But buyers are stepping into the market. You can see the nice aggressive buying. Even in these red bars, you've got aggressive buyers stepping in. So what do you think the market's going to do? You think the market's going to go lower or go higher? Well, when you start seeing a lot of aggressive buying coming in, that's bullish for the market. It's really simple, right? It's not, you're not trying to build some spaceship here, right? This is Japanese yen this morning, okay? Again, we hit the high and we sold off. People say, well, yeah, you hit the high, you got a red candle, you got to sell. Well, why didn't the market sell off from point A? Why point B and not point A? Well, if you look at an order flow chart, this is point A here, but point B, you got 1, 2, 3 selling imbalances. A couple bars later, you got a bar with 4 selling imbalances, right? So, that's how you can tell when things have shifted in the market. You can see on the way up, you're seeing buying imbalances coming in, 1, 2, 3 here, 1 here. You're going up, you make the new high, you got some buying imbalances, but now selling imbalances coming in. Say you're not convinced at this high of the day that, you know what, it's kind of mixed here because you got 3 selling imbalances in this bar, but you got a buying imbalance. The previous bar had a buying balance. The other bar had 2 buying imbalances, and you had, a couple buying imbalances. But by the time you get to the second bar, whack, right? The aggressive sellers just hit all the bids here. It's 36 against 4, 79 against 4, 37 against 4, 25 against 6. And again, this is the chart. And you can see the nice move from, the 96, 97 area on down to, the 96, 87 area. But I'll be honest, when the market's moving quickly, you're trying to digest everything that's happening, it's going to get very confusing. That's why I say let software help you. Let your trading software show you when aggressive buyers are stepping in at lows or aggressive sellers are coming out at highs. Your trading software should be able to show you where multiple imbalances are, and a lot don't. That's why I ended up creating my own software, is because, as a trader, I would look for this, but I was really limited to just, 2 markets max, maybe, because there's a lot of stuff going on and you're trying to process this in real time. This, especially now, the way these markets move, you're getting 20-point moves in, on a 1-minute bar in the NASDAQ. That's overwhelming, especially if you're trying to watch NASDAQ, trying to watch E-minis, mini Dow, throw in crude, and maybe 1 or 2 other markets. It's going to be very difficult. And if you're looking at a normal candlestick chart, you're not going to be able to see where these imbalances are, and you're going to miss these great trading opportunities, right? This is that low there, or that swing low here in this box right here. right? You're coming down and you see these bars with multiple buying imbalances. Now, after it happens, at the end of the day, you look back on your chart and you can say, oh, yeah, look at all these buying imbalances. I should have bought there. But when you're trading, it's very easy to overlook it, especially if you're on a position in one market. Your focus may be 95% on that one market, and you're going to be missing these other opportunities, right? That's why let the software highlight to you bars with multiple imbalances, right? That way you can see it, right? The mind processes images 10,000 times faster than it processes numbers or words, right? So what I had my software do, I've got a lot of tools for traders programmed into my Orderflows trader software. One of them is this multiple imbalances tool to highlight, basically put a box around the bar telling me, hey, you know what, this bar, pay attention, idiot. This bar's got imbalances, multiple imbalances. Just as this bar, this green bar, this other green bar has got a lot of multiple imbalances. And when I start to see them bunched together, then I know, right, that aggressive buying is coming into the market, right? On a move down like I have here, I'm not surprised to see multiple selling imbalances. The market's moving down. People are piling into the market. But when you hit a swing low or the low of the day, and all of a sudden you see multiple buying imbalances coming in, over a series of bars, that's a sign. That's a sign that, aggressive traders are coming into the market. This is a very good low risk trading opportunity because you can join in the bigger traders, right? The bigger traders are the ones that are going to move the market. And when they're aggressive, that's who you want to be trading alongside. So when you're trading live and the market's moving, it's easy to overlook one little piece of information, such as bars with multiple imbalances. That's why I created the Orderflows trader software, my software I use in my trading, to show me situations like multiple imbalances. That way it's easier to follow multiple markets, right? This is that move in the E-minis, right? If, I might have you can very easily miss a move like this right off the low, swing low, for a nice, 10-point move up. So when you're trading on the side of aggressive traders, right, you're trading in sync with the market. That's what you want to do. Markets move up because of aggressive buying. Markets move lower because of aggressive selling. Don't try to beat the aggressive traders. Join them. Don't be the fish swimming upstream that you're trying to jump. Bears know. They know that when these fish start swimming upstream, all they got to do is just sit there with their mouth open, right, and catch them. Don't be that fish trying to swim upstream. Be the guy on the bull that's don't care about. That's joining in. The bull's going to move. He's going to run in a direction. You just sit on him and enjoy the ride. Again, this is the Japanese yen yesterday, right? How can you determine aggressive trading on a candlestick chart? Well, answer, you can't. You can't without looking at the order flow, right? You're seeing it right there. It's clear as day, but if you have, maybe you can catch it on a chart like this. Maybe you can see it. Maybe you trained yourself to see it. But it's just better to have a software that says, hey, you know what? You've got multiple imbalances appearing right here at the high of the day. Then you look and you put two and two together and oh, you know what? I'm at the high of the day. I got multiple selling imbalances. This is probably a high that's going to hold for now. And you take the short. Crude oil yesterday, right? You're coming down, big 40-cent move down. And then you see, again, if you have trained yourself to look at it, look for it, maybe you could pick it up in real time when you're looking at 4 or 5 other markets, and doing your other things, answering emails or whatever when you're trading. Maybe not. Maybe you can. Maybe you can't. But if you have a software that says, hey, you know what? You got multiple imbalances appearing here. At this after this 40-cent move down, all of a sudden you got multiple buying imbalances. Hey, you know what? That's probably a trade you might want to take. Now, give you a word of caution. Okay, don't run out and trade every bar with multiple imbalances. You got to put everything you see in the market in context. A lot of people will listen to a presentation like this up till now and say, oh, all I got to do is look for multiple imbalances. Well, part of trading the way I view it is a puzzle. okay? And you're always trying to put the pieces of the puzzle together, okay? And that's where market context comes in, just as if you're doing a regular puzzle, right, with the pieces, you can't put a piece for the side in the middle or a piece from the middle on the side, right? That's what's called market context. So, for example, this is MNQ, right, micro NASDAQ. And market context is, where do you want to be buying? Where do you want to be selling? Well, on a move down, do you want to be selling at point A or point B? You just had a move down. Actually, the point A should be a little bit higher here. But you don't want to be selling after a big move down. What you want to be doing is looking for a point like C, right? After a move down, you want to be looking for the aggressive buying. Just as after a move up, you don't necessarily want to be buying at point D. Maybe you could always add on, at various levels on the move up. If you got bars with multiple imbalances, there's nothing wrong with that. I do that. But the better entry is going to be at the swing low rather than after a move up. And you know what? The market gives you many opportunities. If you miss a trade, don't panic. Don't say, oh, you know what? I missed getting short at A. I'm going to get short at B. Well, no, just wait for a better opportunity. And sure enough, it came 2 bars later in point C, this time a long trade, right? You miss C, don't necessarily think you got to get long at D. You just wait for, when the market makes a new high, a swing high, to get short and with multiple imbalances. This was yesterday in the cash open in the E-minis. This yellow area on the left is the cash open. Okay, market just went sideways. Then what do you see? All of a sudden, you're starting to see the aggressive selling come into the market. You got a bar with 3 imbalances here, another bar with 2 imbalances, another bar with another 2. And then as you start breaking down, more selling imbalances. So your first sign that maybe this move is going to be going lower was this first bar, at E33 that had multiple selling imbalances, but you're still going sideways. Then finally, when it sort of breaks out of this low area of the first 5 minutes, boom, as you're breaking out, multiple selling imbalances, and the market proceeded to go down into the, down to 82 or so. This is bonds yesterday, right? This is a 4-range chart. Point A is the first low of the day. But if you just because you hit the low of the day and you got a green bar, doesn't automatically mean the market's going to reverse and start trading higher. For a market to start moving higher, you need aggressive buyers to come in. Not just one bar where, it closed higher than where it opened. Then, bar B, the bar that precedes bar B, this one right here at 803, it's actually when the low was made. But the next bar after the low is screaming at you saying, hey, aggressive buyers are coming into this market, right? What do you want to do? Right? Do you think this market's going to go down? Well, there's a chance. There's always a chance of anything happening in the market, but the way to position yourself is for a move up, right? And you started moving up, and you can see you even hit this red bar where you've got 2 buying imbalances, okay? Market closed down. Okay, well, what do you make of that? All right, well, you got some aggressive buying, and you got to watch to see what's going to happen. One, that could be supply, people offering it out, but the aggressive buying is quite strong. You got to watch what happens in the next bar. More aggressive buying coming in, 27 against 586. Obviously, we took out this high of this red bar with buying imbalance, another buying imbalance, and again, it just moves higher. This is wheat yesterday. So I showed you crude oil, I've showed you Japanese yen, I've showed you micro NASDAQ, I've showed you E-minis, wheat, and this is just yesterday, right? So while patterns and order flow repeats in the market, they don't repeat identically. Every market is slightly unique, but once you understand order flow, you can apply it to any market. This is wheat. There's a nice 5-cent move right up off the low. You made 3 lows here, A, B, and C, right? A, B, and C. Well, if you bought A, you get stopped out. Again, I'm not trying to pick the lows, right? I'm always looking for a reason to buy a low, right? I'm not trying to predict the low. Oh, but you hit a low, maybe I should start buying it. We got a green bar. No. Bar B, level B, yeah, it went up, just went sideways and hit the new low at C. But at C, in this area of this low, This is where the aggressive traders finally came in, caused the market imbalance to occur, and the market started rallying, right? You can see this is the low of the day right here in this green bar, but in this bar right here at 1044, you got 3 buying imbalances. 2 bars, 3 bars later, 4 bars later, you got another 3 buying imbalances coming in. Even in this other bar, it's kind of mixed, 2 selling, 2 buying. This one's got a buying imbalance, but you're not seeing a lot of selling imbalances coming in. Sure, they're selling. There's always buying and selling going on in the market, but what you're looking for is when aggressive buyers are in such force, so to speak, that it's causing the market to go out of balance, that the market is going to start moving, right, directionally, right? So hopefully by now you can see how simple it is to reduce, when you reduce the market to the basics, right? You're not trying to, oh, we just had this move down, I got a green bar, I got to buy. Oh, shucks, I got stopped out. There's a couple more green bars. Maybe this is the low, or, hey, we finally hit a low. Finally, once, twice, well, third time's got to be the charm. I got to buy it. Let the market tell you aggressive buyers are coming into the market, or aggressive sellers are present in the market, right? The market gives you a lot of information. It's whether you want to use it or not. If you're just looking at a normal chart, normal candlestick or bar chart, it's just giving you the open, high, low, close. And again, some people will say, well, I don't need order flow because, yeah, it's, any fool can see that you got a big red bar down, sellers are in control. Yeah, but you don't see the big red bar down until after the bar is closed. Okay, it starts out as a small red bar, gets a little bigger, then so, oh my gosh, yeah, it's big red bar, sellers must be in control. Well, okay, it goes down, sellers are in control, but it hits the low. At some point, the market's going to bottom out. And what order flow is going to help is it's going to tell you that the aggressive buyers are in control, right? Just as, here in the bonds. Yeah, we've been trading down, down, down. We hit a low, bounced up, hit another low, but now the aggressive buyers came in, right, and quite strong. 1,917, 653, 158 is not that strong, but, the 1,900 right off the low is pretty strong. It's telling me that, there was a lot of sellers here and the buyers ate through it. There was almost 2,000 contracts on the offer here at 08, but buyers were, damn the torpedoes. This is a great buying opportunity. I'll buy everything you have. Offer me more at this price, because at this price, I know it's a great deal. I think the market's going to go higher. And sure enough, the market went higher. Just like, again, if a market is going sideways, markets make moves that go up, down, they go sideways, right? So, after a move up, oftentimes the market goes sideways. After a move down, market often goes sideways. Excuse me. At cash open, important times of the day, cash open is an important time of the day for trading equities. Market's trying to find its footing. Which way is the order book leaning towards at this time? Is it buying or is it selling? And you can see early on, it was telling you, what, it's kind of going sideways, but it's slanted more towards selling. Okay, great. What, I could take a nice low risk trade. If I'm getting short here at 87, 88, where's my risk? It's just back into 90. You're risking a couple points to capture, maybe, at least 1-to-1, hopefully 2-to-1, maybe 3-to-1 here, right? It's like I said, it's the market speaking to you. The market's telling you what to do. It's like, hey, there's all this aggressive trading going on, all either aggressive buying or aggressive selling. Do something about it. Okay. So, like I said, when you're talking about market context, when you're at highs of the days or swing highs, look for aggressive sellers. When you're at the low of the day or swing lows, look for aggressive buyers. Look for that potential reversal in the market, right? But you got to look for that at certain points in the market. So this past 40 minutes or so, hopefully you'll agree it's been time well spent. Honestly, I can't cover everything in a 40-minute or 60-minute training session, but hopefully by now you should understand the importance of aggressive buyers and the importance of imbalances in the market. So I've got a special offer so you can get everything you need to know about order flow. And if you act fast, I'll give you a very special deal. The charts I showed you are generated from my Orderflows Trader software, which runs on NinjaTrader 8. I'm a futures trader. I've always been a futures trader. NinjaTrader 8 works fine for futures trading. I've used it for, gosh, I don't know how many years now, 8 years, more or less. And it works, it's stable, right? I don't really have any issues. Recently, a lot of these trading platforms, as the market's been making new highs, they've been locking out people. People can't access their account. Honestly, I've never had that problem with NinjaTrader. I think in the past 8 years, I've had one problem where something happened in the euro currency market moved fast. My old computer I was trading on locked up. Okay, that was it. Honestly, in 8 years to have one major issue is nothing. So, people ask, does it work on TradeStation or TOS, TradeOf8? No, it doesn't. Right now, it works on NinjaTrader 8. And what it is the volume footprint chart that you see in this presentation with, I showed you multiple imbalances in the bar, right? Putting the box around it, something simple. There's 17 total order flow related tools in the Orderflows trader, okay? Rather than just having the normal footprint, the tools are like going to tell you when there's a potential sweep in the market, when there's market weakness, and, obviously imbalances, and there's different types of imbalances, value areas. It just really gives you a lot of information from the market. It's really easy to set up. It takes 2 minutes. If you're familiar with NinjaTrader, you're familiar with how easy it is to set up an indicator. Orderflows Trader is an add-on. You don't even need any templates because once you load it and install it, that's the settings. The default is literally the charts that I have up on the screen here. And normally I sell it for $8.99. And really what it is, the Orderflows Trader takes my knowledge of order flow trading and puts it into a program so you can see what the big traders are doing in the market. But having software is one thing, right? You got to know how to use it. So I'm going to give you my order flows trading course for free. And I sell this for $2.97 every day on my website. But I'll also give you advanced training with the Order Flows Inner Circle video series. It's not available to the trading public, right? To get it, it costs $500. It's 56 videos on advanced order flows, tricks, tips, and analysis. So when you add the software, the training, and the Inner Circle video series, that's already almost $1,700. But I realize it's one thing to learn from videos and books, but that's hard for a lot of people. It takes discipline and commitment. But what I found is it's much easier for people to learn in a live classroom session. So for the past 2 years, I've already got every week on Tuesday nights, I do a live training session where you can come in, ask questions. I talk about what's happening in the market, whether you got a question about the software, about the market, about a tool. That's where you can ask and interact with me, every week. There's already 102 sessions. If you can't attend, you get the recordings. This is the recording area. Some people charge up to $200 a month for training. For what? You're buying the software, you should get it for free. But for just a one-time payment of $749, go to orderflows.com/oft3, and that will take you to the page where you can, proceed with getting started with order flows. But a special bonus for investor inspiration, I've got an extra bonus, the order flow playbook. Normally I sell it for $297. You're going to get it for free. So go to orderflows.com. Page looks like this. Scroll down, get here, click on buy now. Click that button to get started. Takes you to PayPal. I don't get your information. PayPal processes everything. And it's just a one-time payment of $749. So you're going to get the Orderflows Trader software, the trading course, the Inner Circle video series, access to the weekly live group training, the Orderflows playbook. Now, if you stuck around, want a copy of my book, go to orderflows.com/book.html. It'll take you to this page. You got to enter your name and email. And after you hit submit, it'll take you to the download page so you can download that book. So getting started is easy. You just got to get up off your butt, type in this URL, www.orderflows.com/oft3.html. The link is in the chat. There's no recurring payments or other payments in the future. Upgrades are free. We've done 3 upgrades already. Well, 2 upgrades. Original version was Orderflows. Then there was Orderflows 2. Now we're on Orderflows 3. It's free, right? The only payments you need to do is to NinjaTrader for their platform, but it'll work on the free platform and your data fees, and that's it. So thanks. Just get started. Thanks for attending today's presentation, Anna. I think I'm exhausted my time. Everyone, I've put the information, the links in the chat for downloading the book, as well as getting started with Orderflows software. So thanks, Anna. I'll throw it back to you.